Hey guys and gals, all you family office folk, thank you for tuning in. Thank you for watching me. This is Greg Silverman, CIOs and bow ties. Although this is our Come Learn With Me series. Every week we take a look at all the articles we've shared and what people's reactions been. Have they shared it? Have they liked it? Comments, feedback? And then we select a few and we'll go through them together in what I call my Come Learn With Me series. Yes, highly intellectual sport, guys. Okay, this article was last week's China signals end to 2 trillion US listing Juggernaut. We all know about what's happening with Chinese IPOs. Let's see. Home and away, Chinese shares fare far better in the US. Oh, okay, interesting. Dispersion between Shanghai Index and the China Select 2000. Wow, let's investigate. 2 decades, Chinese tech firms have flocked to the US stock market, drawn by a friendly regulatory environment and a vast pool of capital eager to invest in one of the world's fastest growing economies. Now the juggernaut behind hundreds of companies worth $2 trillion appears stopped in its tracks. Beijing's July 10th announcement that almost all businesses trying to go public in another country will require approval from a newly empowered cybersecurity regulator announced a death knell for Chinese initial public offerings in the US, according to some long-term industry watchers. Interesting. By the way, it's a cybersecurity regulator. That's interesting. Okay. Yes, the movement of intellectual property. It's unlikely there will be any US listed Chinese companies in 5 to 10 years, other than perhaps a few ones with secondary listings. Likely any US, said Paul Gillis, professor at Peking University, Guangzhou School of Management in Beijing. Wow. The clampdown triggered by Didi Global Inc's decision to push ahead with a New York listing, despite objections from regulators, is already sending shockwaves through markets. I must note that I think Didi was just somewhat, what's the opposite of privatized, socialized, or a public utility. The gauge of US traded Chinese stocks has dropped 30% from its recent high. For investors in companies that have yet to list, there's growing uncertainty over when they might get their money back. Wow. We all know the market hates uncertainty. Wall Street firms are bracing for lucrative underwriting fees to dry up, while Hong Kong is set to benefit as Chinese companies look for alternative and politically safer venues closer to home. 11 point, Hong Kong's Chinese control. It's hard to overstate the importance US markets have held for Chinese firms. The first wave began selling American depositary receipts, surrogate securities that allowed investors to hold overseas shares in 1999. I remember that, unfortunately. My memory goes back that long. Since then, more than 400 Chinese companies picked US exchanges for their primary listings, raising more than $100 billion. Wow. Including most of the country's technology industry. Their stocks late benefited from one of the longest bull markets in history. It's all interesting, isn't it? The first American did that. So these are all points that I highlight and then I summarize them. So, you're going to have to listen to me dribbling on. Within more than 400 listing rating over 100 billion. Feeding the huge tech industry, which is all good stuff. Hong Kong-based website operator China.com Corp began the trend when it went public on the Nasdaq in 1999 during the dot-com bubble. The stock under the symbol China surged 236% on its debut, enriching founders and backers and showing Chinese internet firms a pathway to foreign capital if they could only find a way around the Communist Party's strict regulatory controls. Okay, this is quite the animus. We'll get going, we'll keep going, all right. Unlike companies in Hong Kong, whose laissez-faire approach to business meant there were few rules on company fundraising, mainland-based private enterprises face much higher hurdles. Foreign ownership in many industries, especially in the sensitive internet industry, was restricted, while an overseas listing required approval from China State Council or Cabinet. I exchange for. To get around these obstacles, a compromise was found in the shape of variable interest entity. Complex corporate structure used by most ADRs, including Didi and Alibaba Group Holding Limited under a VI, which was pioneered by now private Sinocorp in 2000. Chinese companies are turned into foreign firms with shares that overseas investors can buy. Legally shaky, hard to understand, the solution nonetheless proved acceptable to U.S. investors, Wall Street, and the Communist Party alike. Well, I will refrain from commenting. Back in China, the government was taking steps to modernize its stock market, which only reopened in 1990, having been shut 40 years earlier following the Communist Revolution. In 2009, the country launched the Nasdaq-style Chi-Nex board in Shenzhen under Xi Jinping, who became president in 2013. Access to the outside world was greatly increased, including exchange trading links with Hong Kong that allowed foreign investors to buy mainland equities directly. In 2018, China began a trial program to rival ADRs, but it failed to gain traction. The most radical step came in 2019 when Shanghai opened a new stock venue called Starboard, which minimized red tape. It allowed unprofitable companies to list onshore for the first time and got rid of cap on Thursday price moves. They also scrapped an unwritten valuation ceiling, which forced companies to sell their shares at 23 times earnings or less. Wow. But mainland exchanges still don't allow for dual-class shares, popular with tech firms because they give founders more voting power. Hong Kong introduced the structure in 2018. The goal was to create an environment which would enable Chinese tech firms to list successfully at home and be less reliant on U.S. capital. This need became all the more pressing as tensions between Beijing and Washington increased during the latter part of former President Donald Trump's presidency. Trump introduced tough new rules that mean Chinese firms may be kicked off exchanges in a few years' time if they refuse to hand over financial information to U.S. regulators. Our secondary listings in Hong Kong picked up. Chinese firms still preferred New York, where it takes weeks rather than months to process an RPO application. China's strict capital controls meant domestic exchanges couldn't compete with New York on liquidity and far higher valuations for tech companies. China Inc. raised $13 billion through the first-time share sales in the U.S. this year alone. Wow. Record that. After Didi's contentious June 30 IPO, it appeared the Communist Party decided it had had enough. The death of ADRs was inevitable, said Fraser Howey, author of Red Capitalism, the fragile financial foundation of China's extraordinary rise. What's interesting is the mold and template that's achieving that result. It's coming from a mindset of control and clamping down on business. It's very different to a mindset of reform and building markets domestically. Beijing's move to regulate overseas IPOs coincides with stricter controls over Chinese technology firms, many of which have near monopolies in their field and vast pools of user data. This campaign to rein in the tech industry has accelerated in recent months as Xi seeks to limit the influence of the billionaires who control these firms. The Chinese companies already listed in the US. What happens next largely depends on what China does with these. Banning them outright would be unlikely, as it would force firms to delist from foreign exchanges, unwind that structure, and then relist, a costly process that could take years. The updated regulations are expected to be ready in a month or two, people familiar with the matter have said. Hong Kong is increasingly looking like a viable alternative. For one, China plans to exempt Hong Kong IPOs from first seeking the approval of the country's cybersecurity regulator. Bloomberg reported last week, in a forced US delisting, firms that already sold shares in Hong Kong, like Alibaba and JD.com, can migrate their primary listing to the city. The delisted US receipts, which can still trade off exchange, won't be worthless because they represent economic interest in the company. What? The delisted Hong Kong's open markets and greenback peg currency should facilitate the conversion. Holders can sell their ADR before they are delisted or convert them into the Hong Kong listed common stock without much disruption. The company choosing to terminate its ADR program entirely can also pay out a dollar amount to investors. But the outlook for Hong Kong's role as global financial center is looking more uncertain in the wake of the Biden administration's warning over doing business in the city. Wow. on. Okay. An index of Chinese shares in an index of Chinese shares in Hong Kong fell 1.9% on Monday, taking its loss since the January peak to about 19%. Either way, it seems that two-decade era that saw China's most successful and powerful private firms listed in the US is coming to a close. The message from Beijing is clear. The Communist Party will have the final say in pretty much everything, including IPOs. It is really important to own companies that align with the direction of the Chinese government, said Tom Massey, co-portfolio manager of GWNK Investment Management's Emerging World Strategy Fund, which has half its money invested in Chinese stocks. Oof. That'll be worrisome. I will not be financing companies that are going to circumvent anything that the Chinese government wants to accomplish. Wow. Well, that was super interesting, guys. Well, I hope you enjoyed it. I really enjoyed it. And you learned something in my Come Learn With Me series. Check out gregsilverman.com for some more information, or check me out on some of my social channels. Out.